We've heard from a lot of skeptics already this morning. Let's get to the constructive view. How do you justify this valuation?
Right. Well, it'll be an expensive stock in the near term, but our numbers have it looking pretty decent on 2029, 2030 EV multiples. So, it's going to be a tough ride, a rocky ride to get there, and it can be uncomfortable to value a company so far into the future, especially in this space. But if it hits those numbers, I mean, this stock could even look cheap.
Well, Matt, let's focus on revenue, how much money they're making at the moment, what growth has looked like over the last few years, and the numbers you're thinking about in the forward years, next year, the year after that. How much growth are we going to see in revenue?
Right. I mean, we only saw, 15% revenue growth in the first quarter, but this is not going public off of its most recent quarter. It's going public off of what it can do in the next few years. And we're expecting it to more than triple revenue in the next 2 years. That would give us more confidence in this valuation. And how can it do that? Well, a lot of it's already underway with that Google and Anthropic deal. And then, if they can get Starship underway, if they can continue growing in the connectivity Starlink space, I think they can get there.
Key question, Matt, where exactly is the revenue going to be coming from, and does it matter? Does it matter if it's mostly a NeoCloud story or if it's mostly a Starlink story that does propel the earnings higher?
Most of the revenue is going to come from the AI side, likely. At the same time, Starship V4 is really going to be that keystone to the company's plans, with connectivity drawing the most EBITDA in the near term as well. So on the top line, I think AI, but you really can't discount the other two pillars here too.
How much more different is it to try to value some of the companies that are IPOing right now versus, say, 5 years ago?
Yeah, I mean, it used to be easy. You could just look at any software company and then the 10 closest comps. This feels like new territory. Like I said, we're not comfortable. We're not usually going out to 2029, 2030 numbers, but you kind of have to. This feels almost more like a $1 trillion venture investment. And I expect the same will be true of Anthropic and OpenAI.
Matt, what do you do when it comes to total addressable market? The TAM of this company, when you start thinking about going to outer space and there's not much competition, just sounds insane. Some of the numbers I've heard over the last few weeks just sound almost made up, Matt. Where did the numbers come from?
I'll be honest, we always discount the TAM pretty heavily. We see very inflated TAMs in prospectuses. So we kind of take that 20 plus trillion TAM, we kind of set it aside and look at what the company's been able to do and where we think it can go. We kind of disregarded that at 20 trillion plus enterprise AI. But, I think there's no question AI infrastructure is huge and growing. The potential for the Starlink is already very established and growing very fast.
Matt, can I ask you, we were talking about growth, and clearly the IPO is not priced off the trailing years, obviously. We're talking about the hope of the future. But, Matt, I am interested in the growth levels coming into this listing. Why aren't we seeing aggressive growth, and why is it going to change quickly in just the next 2 years?
Yeah, I mean, I think the launch business has really been focused on bringing those satellites into space, helping the connectivity, the Starlink business out. And then on the AI side, that's mostly been plowing money into CapEx, and now it's finally at that inflection point. And, those deals with Google and Anthropic have given us confidence. The fact that Google is also raising billions of dollars to build out its own data centers and other companies, I think they're in the right space. I think a case could be made that, it's a bit risky to build out all of this infrastructure. What happens if there's overcapacity? But for now, pedal to the metal, it looks like the smart play.
Matt, you agree with some of the skeptics, and in one particular point, you said that this looks a lot like a $1 trillion venture capital bet. Do you think it's appropriate that this go into a lot of the indexes and be available widely to retail customers at a time when essentially it has a characteristic more of venture capital than, say, traditional equity?
Well, you could take a look at Tesla. That took a long time before it got into the S&P 500. There's all sorts of, growth companies, mature companies. So I would say that there's a spectrum of what's appropriate for what goes in an index. And this company kind of feels like a growth company on steroids. So I believe it can justify its $1.75 trillion valuation. I wouldn't say it's, inappropriate to be going into indexes whose, goal is to track the market. If people don't want to own those index funds, they can certainly sell.